My name is Marisa Drew, and I'm the Chief Sustainability Officer for Credit Suisse. Welcome to today's CBI conference theme, which officially is entitled Transition and the 2030 Targets, but with the unofficial tagline of 2030 is the new 2050. So whether you're participating today as a market practitioner or as a concerned citizen, the recent IPCC report was a shocking wake-up call to all of us, even those of us like myself who are steeped in my day job in the climate mitigation arena. And it basically told us that the march of climate change is accelerating at an increasingly rapid pace. We, of course, have to look no further than the catastrophic weather events that took place over this summer, including not only the direct effects of Hurricane Ida, but also the residual effects just a few short days ago in New York City, where so many lives were lost. And when the rain broke all new records, but it did so with virtually no warning. And of course, the US had its more than its fair share this summer, whether it be wildfires or droughts or hurricane activity, but it was not immune anywhere else in the world. Everybody felt the effects of record-breaking climate events. So Mother Nature is telling us loud and clear that we're running out of time to avoid inevitable tipping points. And that's why today's official and unofficial CBI theme is so apropos. This decade really is indeed our last chance to keep the world in a habitable place, and we simply have to mobilize capital at speed and at scale to fund the business model and operational transitions of our highest carbon emitting sectors. Therefore, I commend the CBI for taking a very strong stance in trying to define a market standard for what a credible transition really looks like, and also what it is not. And at Credit Suisse, we're very proud to have partnered not only with the CBI, but with many of you watching today to attempt to define a set of principles behind a credible transition. And that can be, for instance, by setting ambitious goals and very hard targets that you'll hold yourself accountable to, of course, instead of empty statements without an intent or substance. But also by trying to do things like articulate where there is a place for carbon offsets, where it's acceptable, and where offsetting cannot be used as just an excuse for BAU, business as usual. So all of this work is being done in the belief that many of us, and all of us, frankly, in the markets, really have to band together. We've got to link arms, and we've got to set a high bar for ourselves in the finance sector. And if we do that, we're going to give the markets confidence, and we're going to have the ability to facilitate an even greater level of capital at an even greater pace, so that truly and collectively, we can together ensure that 2030 is indeed the new 2050. So I hope you enjoy the day, and thank you very much for watching.
Great. Hello, everybody. We're very pleased to have you with us today for Transitions Day at the Climate Bonds Conference 2021. I'm Anna Creed. I'm Associate Director of Thought Leadership at Climate Bonds, and I'm very pleased to be joined by Nathan Fabian, who's Chief Responsible Investment Officer at PRI, and also the Chairperson of the European Platform on Sustainable Finance. So hello, Nathan, and welcome.
Hello, Anna. Good to be with you.
Excellent. Nathan and I are going to be talking with you today about market evolutions driving the finance for the transition we need to make. Just by way of some opening comments from me before we get into discussion, transition is obviously something of a hot topic these days. The recent IPCC report has re-emphasised the decarbonisation the world must undertake by 2030, that it's steep and front-loaded, and it demands immediate and far-reaching action across all sectors of the economy and in all regions. We're already in a climate crisis. Transition to date hasn't been fast enough, and it hasn't been extensive enough. Efforts need to be ramped up significantly. This means moving rapidly from high to low to net zero emissions to achieve a net zero global economy and also a more resilient and equal society. I'd stress that this is inclusive. No industry or organisation can be left behind. While progress has been made in expanding renewable energy supplies and reducing our reliance on fossil fuels in the energy and transport sectors particularly, many activities continue which have the potential to stall or undermine the low carbon transition. We need to bring those into the fold. This includes decarbonising hard to abate sectors whose goods and services are needed into the long term, so heavy industry and aviation, for example. It also includes companies practicing what are sometimes called stranded activities. But here the transition is different. They need to switch up their business away from the stranded activities and towards activities with long-term climate viability. An example here would be fossil fuel related companies switching to renewables rapidly and at scale. And of course, even while we talk about decarbonisation, we're very mindful of other critical environmental and social goals that need simultaneously to be transitioning to, and those goals being established by the SDGs. And the way that those transitions are undertaken is key. There must be just transitions that address citizen participation, job creation, and measures to address the social and economic impacts from some sunset sectors. In terms of finance for these transitions, estimates suggest that an annual US dollars of nearly 7 trillion in infrastructure investment is needed alone, as well as a corresponding figure of about 1.5 trillion and 4 trillion for the energy transition to meet the Paris Agreement targets. So driving private capital towards transition investments is going to be key to scaling up finance. Public money alone is not sufficient for the investment needed. And Nathan, with those kind of opening comments in mind, just to hand over to you with your background of your investor constituency, any thoughts you have on this transition concept and need?
Thanks, Anna. Yes, I agree with you, and I think investors know that transitioning of the economy is something that is underway and that they face in future. And they've been signaling their awareness about the importance of these environmental and social factors for many years, of course. I think what we've realized, though, after years of focusing on potential environmental risk and some future transition, that we're at a point now where we need to be far more specific and granular about what the environmental and indeed social performance of our activities and our companies, our investments needs to be in order for this transition to be one that we would choose, one that meets the environmental goals and like the SDGs that you mentioned. Transitions that don't meet these goals or that really have negative environmental and social effects are bound to be disruptive ones. They're bound to be volatile. They're bound to have government intervention, which is difficult for investors to deal with. So really we need to have a granular way to contemplate and plan for a transition that meets the goals. I could go further on this, Anna, if you like. So if we look at something like the TCFD, I think it's a very interesting bellwether or indicator for where the majority of the market has been and is probably currently today. There's an awareness that companies should be disclosing to investors using a framework like TCFD to indicate that they understand the problem on climate and transition, that they have some structure and governance in place to deal with the problem, so indicate they're willing to address the challenges, and that they have some plan in place and some way to monitor their progress, and that this is supported by the company. This is well and good, but I think what we're now realizing is that we need something else. Investors are now needing to ask, is the plan credible relative to the environmental context and goals? Is it being implemented in practice? Is the sustainability performance that's being achieved under the plan in the assets and activities of the company, are they sufficient to maintain the business model through the transition and maintain the earnings for investors? These are much more granular questions about environmental performance and how the balance sheets and investments of the companies are being implemented. We're now at this point, and I think if you look at emerging coalitions like on the Net Zero Asset Owners Alliance and the Net Zero Asset Managers, they're actually setting net zero goals and now asking, well, what investments should I hold? How should my companies and my portfolio be changing their balance sheets? What proportion of my portfolio needs to be goal aligned today, and how much in say 2025 and 2030? And so we're at this much more granular stage now. I think that's a good thing, but really that progress is actually probably a little overdue.
Yeah, I think that's really interesting as well. And just to add some reflections from the bond market specifically on that one. In the bond market, we've seen in the use of proceeds bond, a lot of growth and expansion from green to social to sustainability, and sorry, excuse me, also transition labeled bonds. Recently, I think we've had 13 bonds to date transition labeled. Some of those from corporates, some such as Cadent and SNAM and Marfrig, and a number from the European Bank for Reconstruction and Development, who labelled theirs as green transitions. And use of proceeds bonds have always had that level of granularity on the criteria for what's eligible, and there's a lot of initiatives working on those criteria. What we've also seen, and therefore I think it's interesting that transition bonds are coming into this space where there is an expectation of that level of granularity. If you're going to call it a transition use of proceeds bonds, you will be subject to some sort of criteria and external verification around how you're going to use the funds raised through that bond. At the same time, I think what's really interesting is we've seen the rise of sustainability linked bonds and linked loans, effectively instruments raising general purpose debt in the main, tied to company level performance indicators. And these KPIs, to some extent, I think, define their ambition, transition ambitions and targets. They're about forward-looking targets at the company level, which is, in my mind, what transition is all about. Certainly, there's a lot of work to do and the scope and the ambition on some of those KPIs, but there is actually a lot of organisations working on that, and that's a critical area of focus. And the next session after this one is from people working on those initiatives to try and bring that granularity into what would be credible transition commitments, targets, etc., for companies, and their commitments to that and their ability to carry out and deliver on those targets as well, sort of a two-pronged approach on that one. But one thing that's been very interesting about the rise of sustainability-linked bonds is that we have seen them being issued by issuers in sectors generally considered as hard to abate. They've been quite popular with hard to abate sectors in the market. And they also have been attractive for issuers because they might not have sufficient capital expenditures to do use of proceeds bonds specifically. They might appeal to smaller issuers who lack the capacity to implement effective tracking on detailed use of proceeds, or generally to issuers who simply prefer to set performance indicators and reporting targets at company level, mindful of the push now for companies to have net zero targets. It kind of makes sense to align these things in their financial instruments as well. So I think it's a very interesting move into the SLB space, and there's another one that's really helping to open up the opportunities for both issuers and investors relating to transition. So that's one thing I just wanted to add from the bond market on that space. And obviously, of course, moving on to the EU taxonomy, that is all about granularity. The EU has set a target to reduce its emissions by 55% by 2030 and to reach climate neutrality across the whole continent no later than 2050. The taxonomy, the EU taxonomy, I think, is driving change by setting out clear and consistent screening criteria at that kind of granular level by sector and by economic activity that's aligned with those decarbonisation targets for a large number of economic activities, including those generally thought of as transition activities hard to abate. So cement production, steel production, are already in the EU taxonomy. Aviation will be in it soon, we hope. So that's really important that they've got space in the EU taxonomy and recognised alongside activities such as renewables that are closer to net zero today. The other interesting thing and important thing about the EU taxonomy, of course, is the mandatory disclosure requirements applying to both investors and also large companies practicing those activities. It's a critical first step, I think, that these things are recognised in the EU taxonomy. Of course, it's a first step. There is further work ongoing to expand the taxonomy to all sectors that need to decarbonise, potentially develop transition pathways for those activities, pathways that show the route down to net zero for a sector that is aligned with the Paris Agreement goals of definitely 2 degrees and ideally 1.5 degrees. That's important, that there's common pathways that people are following for consistency, which is one of the goals of the taxonomy. And also, I think it's probably worth noting as well the work that's going on by the platform to look into recommendations around a significant harm taxonomy, which I think is particularly important for facilitating a rapid and just transition away from stranded activities. We need to know what those activities might be, and then we can work out how we can best work to transition them to decarbonise as entities, even if their current activities need to be wound down in some way. So, and obviously, just very briefly, there's a lot of work going on in other countries around the world developing their own taxonomies. Some of them have got quite a transition focus. The Canada Standards Association started a process on a transition taxonomy, and they were looking at 7 priority sectors, including oil and gas, utilities for energy production, agriculture, forestry, aviation, etc. So a lot of things, and mineral mining as well. So a lot of things that are seen as activities that are high emissions and really need to transition. And in July of this year, so only last month, the Canadian government announced that they were going to create a new Sustainable Finance Action Council to take on the role of developing that taxonomy, transitions taxonomy for Canada. And similarly in Japan, in April this year, the Financial Services Agency published draft guidance or guidelines on climate transition finance that are aimed at promoting financing for businesses that are either already decarbonising or decarbonised. And Tokyo plans to set up a working group later this year and next year to put together detailed transition roadmaps for each sector and each industry that emits heavy greenhouse gases, including steel, chemical, power, gas and shipping. So that's a very interesting move from Japan as well. So, but coming back, Nathan, to the EU taxonomy, given you've been instrumental in that work, and the report was released in March this year about transition finance from the platform relating to connections with the EU taxonomy, etc. What are the key takeaways from that? And what do you think are the key messages for users of the taxonomy about how the taxonomy is helpful for them getting to this level of granularity and advising them on their transition strategies?
Yeah, thanks, Anna. It's important to see the taxonomy as a performance benchmark, which we need as an additional layer of information to company level information. So company level analysis is good for working out financial impact and risk. But if you're trying to go to sustainability performance, you need to look inside the business. And the taxonomy adds this additional layer of information, and we're going to need it if we're going to understand goals. So that's the way to think of it. The legitimate question was put, well, what if I can't meet that criteria in the taxonomy today, but I still want to get some recognition from the market? I might be able to reduce emissions in a very harmful activity that may ultimately exit because it's too emissions intensive, or I may only be able to take some small steps today. Maybe the technology pathway is not really affordable economically for me to make an investment case right today, but I can still make some improvements. So there should be some recognition in an activity level framework for these improvements that can be made. And so the transition transition report of the platform identified that sectoral and activity pathways can help companies, investors make decisions. We also recognize that what we call as harm reduction or improvements, even though they're not sustainable in the long term, these are improvements that could be recognized in the taxonomy. And we've released a report recommending additional categories, if you like, in the taxonomy, so that we can recognize those improvement areas, even though they're not sustainable. So transitional spaces in the taxonomy. And it can help answer some of these questions. The taxonomy is flexible enough to do that if we choose to use it for that purpose. None of this really changes the underlying fact, though, and that is that generally the market underestimates the level of environmental performance that must be achieved. On climate, the reduction curves are steep and front-loaded, and the next investment round in our infrastructure, in our heavy assets, in our companies especially, they need to have excellent performance. They need to have very, very low emissions performance if they're going to stay operational through this transition phase. And so that's really what the taxonomy and this activity level benchmarking can give us.
Yeah, thank you, Nathan. I think it's interesting. It's an idea that we've been developing at CBI is about our view is that there needs to be a common sectoral or economic activity transition pathway which aligns with the Paris Agreement, so that companies are reporting against the same pathway, not just a percentage reduction compared to their business as usual or their historic emissions. There's very definitely a common sectoral pathway, but do we give leeway for people that are off the pathway at the moment but making active steps to get on it in a time-bound period? That's a bit of a teaser, I guess. I think we're both kind of exploring that. And when you talk about the EU taxonomy and the recommendations for space within the taxonomy for measures that can be taken to reduce emissions, even within an activity, aside from that might need to be phased out, etc., is a really interesting one. There's obviously decommissioning of fossil fuel stations is a really obvious one here that I think all of us would like to see happen, as opposed to just divesting them. So those kind of things will be very interesting to talk about. But that said, I think we're nearly at time. That went by in a flash. So Nathan, I'm going to thank you very much for joining us today, and I hope everybody found this useful as an introduction to transition and the concept of transition and what's going on in the finance and the taxonomy space relating to it. And do reach out to us if you have any further questions. I'll be happy to continue the conversation, and enjoy the rest of the day. Thank you, everybody.